All right. So now let's talk about derivatives. See, if I talk about derivatives in simple terms, derivatives it means it's a contract of financial instruments.
Okay.
Contract of financial instruments. So now instruments it could be anything. Anything means anything. Means wherever you see the opportunity of making some gain out of it, so that instruments you can call it as a means assets or instruments, I would say. For example, land. So that could be your instruments, right?
Hmm.
Open land or commercial land, agricultural land, right? Land. Then stocks, bonds, loans, currencies. So that all comes under basically an instrument.
Okay.
So basically, buyer and seller, they use you know the uh, the the derivatives contract, I would say, to increase their gains as well as to reduce or minimize the risk. How?
Hmm.
So I'll just give one example. Let's say you have purchased your new car.
Okay.
You have your new car. The car worth is 1 crore. Let's say you purchase today and very next day you met with an accident. Unfortunately, you are safe, but your car now damaged,
Okay.
right? And for a repairing, you need at least 20 lakhs to
Hmm.
change. Let's say, you know, it could be in any part of car.
Hmm.
1 crore, right? So 20 lakhs now would be your loss, correct? So you
Yeah.
purchased an asset, but very next day you met with an accident, and now you will have to pay 20 lakhs to repair your car.
Okay.
Let's say this guy again purchased same worth of rupees car, but at the time of you know purchase car, he or she also purchased the insurance, car insurance.
Yeah.
Let's say this guy also same met with an accident, unfortunately,
Hmm.
but now and same level of cost also incur 20 lakhs for a repair of car. But with the the this person condition, this person is holding an insurance which is a protection, right?
Yeah.
So immediately this guy can call to the insurance company. Hey, hi company, I'm this and this, and my car met with an accident, and this is the bill which is required to repair my car. Can you please reimburse it? Then company will do their procedure and they'll reimburse the amount, correct?
Yeah.
But in return of this guy is paying the premium every month, right?
Yeah.
Premium for what? Premium to protect his asset, right? Asset, it means any
Yeah.
precious
Yeah. Yeah.
goods, will call it as an asset.
So,
So car is a precious goods. Why this is possible? Because of derivatives only.
okay.
Because of
Derivative.
derivatives only. Because this is something, when we say insurance, so we are signing a contract, correct?
Yeah.
So both the parties, insurance company and car owner, both they are signing a contract between each other, but they are signing contract on what? They are signing contract on value of car, which is an asset. So here
Mm.
the underlying product would be car.
Mm.
Are you getting my point?
Yeah. Yeah.
So underlying product would be car.
Car.
But if I talk about now financial instrument, in a finance world, underlying instruments should be land, stocks, bonds, currencies, and loans.
Okay. Okay.
But the logic remains same.
Mm.
Parties will pay the premium to protect the value of stocks.
Mm.
If something happened in market, right? So
Yeah.
contract means they have a contract, so other party will compensate that losses.
Okay. Okay. Mm.
Right? For example, let's say you invested in a stock, the price was
Mm.
100.
Mm.
Now you are worried about market collapse due to
Mm.
geopolitical issues. So what you can
Mm.
do? You can purchase one contract
Mm.
with a price of 100,
Mm.
pay 10 rupees premium
Mm.
and sit relax at home.
Okay.
Your maximum loss would be premium, because anyways if nothing happened, then in a insurance also, if nothing happened, let's say, then insurance companies, they don't repay your money back, correct?
Correct. Yeah,
So it
that's
is
right.
their income eventually, because
Yeah.
on your premium they are taking risk.
Correct. Yeah.
So same thing happened in this your
Derivative.
contract as well, investment contract as well. If let's say if price drop in market due to XYZ reason below the 100,
Mm.
it could be 80, it could be at let's say 60, 70, even 0. So you can claim
Oh, okay. Mm.
entire amounts. But the key difference which you can see premium and the stocks, the this derivative strategies is like they have a time limitation basically. One
Oh, okay.
week, one day, 1 year, 1 month.
Okay.
So that's
Mm.
how it becomes unique.
Okay. Mm.
See, same derivative contracts, hedge funds, they use this contract to multifold profit. And same
Mm.
derivative contracts, they put you in a huge risk. Now, in
Mm.
terms of let's say this premium wala funda, this one,
Mm.
you just let's say pay the premium, total premium of 50,000, because let's say you just purchase a car and very next month or next 2 months, let's say, or after 2 months, you met with an accident.
Mm.
So how much amount you paid so far? Just 50,000. But now
Yeah.
you are claiming for how much?
Huge amount. 20 years sort of.
20 lakhs.
Mm.
This is the risk of insurance companies. So
Mm.
in a finance market, basically same level of risk, who take it?
Mm.
Hedge funds. Basically, they take this risk and they sell the options to the common people like us for their investments. See, insurance companies, they're making huge profit even if you submit the claim. Maybe they're not making profit from you, but they're making profit from others' premiums, because
Yeah.
everyone can't submit bill for
Yeah.
20 lakhs, right?
Correct. Correct. Yeah.
So same logic applies in a stock, bonds, and loans, and currencies or land market as well. You can see a derivative contracts where hedge funds actually protect your portfolio against market risk, where you just need to pay premium to them.
Okay. Okay. Okay.
Did you get it?
Got it. Got it. Okay.
This is how your derivative means, looks like. In short, derivative is just a contract, I would say, just a contract
Okay.
which can be signed for any financial instruments depending on the nature of that particular contracts.
Mm-hmm.
Right?
So this is offered by the fund company, derivatives?
No, see, anyone can do it. Even common people also can do it. You can also do it, but it is a
Okay.
risky, I would say. So most of the, see, nowadays the influencers, like, they just
Mm.
manipulate or influence people to invest trades in derivatives. But let me tell you a data: 98% people, they are losing money in derivatives. Only
Oh.
2% people they are making money. So it means only hedge funds they are making money, or HNI investors who have a big appetite, they are making money. They are
Mm.
making money by selling, protections to your investments.
Mm.
And people, who are losing money, who are buying protections, because
Okay.
if let's say if market, behave like very volatile every day, so that doesn't make any sense to purchase options, every day, correct?
Yeah. Okay.
Are you getting my point? But
Yeah.
people, they always purchase the options, and they
Mm.
always purchase the options and lose the money. So it means, for example, let's say you're purchasing option that, with the expectation like market will crash, right?
Mm.
But on that day, let's say what happened, let's say the market was up, means it was a positive sentiments and market was
Okay.
up, you will lose your money.
Correct. Yeah.
So what your premium you have paid it.
Okay.
So this is how the common people, they are losing more and more money. Same kind
Mm.
of, let's say, insurance. You purchase insurance for 1 year, and you committed to the insurance company that you will pay 5 lakhs to the company as a premium,
Yeah.
right? Let's say throughout that year nothing happened to your car,
Mm.
and you paid a 5 lakhs.
Mm.
So it means for you, it's your loss, correct? You paid
That's
a
right. Yeah.
premium, so it was your loss because nothing
Mm.
happened to your car during that period. So same
Correct.
thing
Yeah.
happened in financial market or derivative market as well. If nothing happened, then you don't need to pay any single penny to anyone,
Okay. Mm.
right?
Yeah.
So basically, it's a game of like more risk, more profit. So who take the more risk? Insurance companies take the more risk. So same way in a finance market, hedge funds or HNI investors, as we have discussed, like big investors, they take a big risk and they make a huge profit,
Mm.
right?
Okay.
So this is how your derivatives looks like, but there are types of derivatives, so which are more complex, I would say. So I would like to cover one or two
Okay. So I want to get some understanding at a very basic level on this.
derivatives, right?
We talk about
Yeah,
swaps,
yeah. So that comes in the
futures,
derivatives only.
options. Okay, okay. Those are, yeah. I'm at a
That
basic
comes in
level.
the
Yeah.
derivatives only. So
Okay.
now I'll just prepare a chart of derivatives.
And also, I want to, if you could help me, relate why we are talking when it comes to hedge funds only. We are talking more about derivatives.
That's, see, they make a profit through
Okay.
derivatives are more risky, and the
Mm.
hedge funds are famous for our derivatives
Okay.
because they take more risk. See, derivatives basically help to increase your appetite.
Mm.
So, for example, let's say you have a capital of 100 rupees, right? If you, and let's say share price of ABC company is 100 rupees. So in your capital, you can just purchase one share, right?
Yeah.
But through derivatives, you can share 10 shares. So it means
Mm.
you can sign a contracts for thousands of rupees value, or basically
Mm.
10 shares. Why? Because you can pay premium only.
Mm.
Just pay premium. Means
Yeah.
you have a capital of 100 rupees, so just from that capital you can pay premium. You can hold the contracts of 1000 rupees.
Okay.
So through this, you can multiply your profit as well. See, if you hold one share, let's say that share price changed from 100 to 1110, so your profit would be 10 rupees, correct?
Yeah.
But in this case, you're holding 10 shares, so 10 into 10, your profit would be 100. So this is how you can multiply your profit through derivatives.
Mm.
You get it? So
Yeah.
derivatives are risky that offer opportunity as well to make more money also.
Mm.
Derivatives types. We have discussed what is derivatives, but now we
Yeah.
will discuss types of derivatives. Just 1 minute, my wife is calling again and again.
Okay.
I'm in a station. I'll call you back. All right. Derivatives types.
Mm.
So now, if I talk about types, we have two types of uh, you know derivatives basically: exchange derivatives and OTC derivatives.
Mm.
OTC derivatives. OTC, it means over the market, over the counter market.
Okay. Okay.
So it's a direct market basically. For example, I purchase my course or let's say one-on-one mentorship directly, right? So there was no
Yeah.
intermediator in between, correct?
Correct. Yeah.
You direct reach out to me, you negotiated with price, and you purchased my
Mm.
subscription. So that transaction, you can say it's a OTC market.
Okay.
So it means you can meet potential buyers and sellers anywhere, and you
Mm.
can execute a contract. That
Okay.
becomes OTC market. You can
Got
meet
it.
potential parties around your home. Maybe you can meet somewhere in cafe. You can meet somewhere in any other place.
Mm.
So that market, you can call it as an OTC market or OTC derivatives. But if I talk about exchange, it
Okay.
means you cannot execute contracts outside of exchange. So we have two exchanges. One is NSE and another one is
Yes.
BSE, National Stock Exchange and Bombay Stock Exchange.
Mm.
All right. So let's discuss now what are the exchange derivatives. So which are exist on exchange. One like options. So you can purchase options from the NSE and BSE.
Mm.
Right. You can purchase options, but what is options and all, we'll discuss that in details.
Okay.
So options you can purchase from the NSE and BSE. Then
Mm.
we have a futures as well. Future, again, that is a part of derivatives.
Mm.
And another one is CDS, which is credit default swaps. So credit default swaps and premium, right? Credit default swaps and premium
Mm.
means insurance premium, I would say. So both are same.
Okay. Okay.
Both are same because we purchase CDS to protect the stock investments, bond investments, or whatever investments that you have from the
Mm.
market
Okay.
uncertainties.
Mm.
Same
Got
way,
it.
if we discussed about car, right? So
Mm.
that person wanted to protect his or her car. That's what that person purchased the CDS, or let's say insurance of his car, right? So the
Yeah.
CDS, it's like an insurance only. There is no
Mm.
change in it. Every year, or every month, the parties pay uh, insurance basically to
Mm.
the, or premium basically to the party, the insurance seller, like insurance companies. All right. But
Yeah.
options and futures, both are little different. But we'll discuss that in detail. So let me just try to first uh, write down the all different types of derivative types what we have.
Okay.
And on
Okay.
the OTC market, we have forward, forward derivatives, and another one is your swaps, swaps derivatives, right? So these are the basically types where you can see, which comes under derivatives. But from the means differentiation perspective, like exchange and OTC, exchange, derivatives are like highly regulated derivatives.
Okay.
Highly regulated, and here you can see the exchange take care of everything, which is work as a central counterparty. So it means you can directly buy and sell options and futures to the exchange like BSE and NSE. You don't need to directly meet any person anywhere.
Hmm. Hmm.
Directly you can sell it to whom? To the exchange, BSE. That
Exchange.
means
Okay.
BSE will take care of it.
Okay.
And options and futures both are even CDS, all three are like highly regulated.
Okay. Hmm.
Even single penny of difference also you can't carry.
Hmm.
And the options, they have the different settlement cycle. Like most of the options, they have a weekly expiry. Futures, they have a monthly expiry.
Okay.
But you can take a discharge from the contract at any point in time. In an
Hmm.
insurance agreement also, what if, let's say, you purchase insurance with the commitment that every month you will pay 50,000, but after 6 months you feel that you know uh, you are not happy with the 50,000 amount, because the
Hmm.
other competitors of that same insurance company, they're offering the 1 crore corpus of
Okay.
cover to investment in 20,000.
Okay.
Then definitely you will try to take a discharge from that particular company, and
Yeah.
you can
Yeah.
buy new cover, new
That's right.
amount, right? So that
Yeah.
process will call it as a discharge. So same here
Okay.
also, the expiry of the contract means contract will expire in a week, right?
Hmm.
And this future contracts will expire in a month, means every month it will expire it.
Hmm.
But during that period, you can take a entry and you can take a exit at any point in time, as and when
Hmm.
required,
Okay. Okay.
right? So sometime you may see profit in your premium, sometime you may see loss in your premium, depends on the basically price of the asset.
Okay.
But we'll discuss that through examples only, so theoretically it would be tough to understand,
Okay. Okay.
right? And same for OTC as well. In OTC, basically the key difference is, all OTC contracts, they are like customized contract.
Okay.
Buyer and seller, both they can directly negotiate with each other.
Hmm.
So you don't require any third party in between.
Okay. Okay.
You can make together and you can execute the contract.
Hmm.
So this is how your OTC derivatives work. So you can directly execute contracts,
Okay. Okay.
right?
Yeah.
So means these are the types of derivatives, basically forward derivatives and swap derivatives. But we'll have to discuss in details. Then only you can understand it.
Got it. Okay.
So we can pick one which is swap derivatives today, and
Hmm.
rest part we can cover it out in the next session.
Okay.
So now if I talk about swap derivatives, right? So the meaning of swap is exchange, right?
Yeah. Exchange. Correct.
Exchange. But in a finance or investment world, what we can exchange? Come on, what we can exchange?
Exchange of an instrument.
Exchange of an, yeah, correct, instruments. What else? Exchange of currency,
Hmm.
right?
Yeah.
Exchange of profit,
Hmm.
exchange of interest. Am I right?
Yeah. Yeah.
And even exchange of risk as well.
Hmm.
So this risk wala part already we have discussed, which is a insurance, right?
Correct. Hmm.
So
Hmm.
you can take insurance for your investment. So charges become CDS eventually,
Okay.
credit default swap. If something happened with if something happened to investments, then insurance company can reverse that claim. So eventually you can take a cover, I would say protection cover to investments for the
Mm.
market uncertainties. That is
Okay.
something your risk cover. What about currency? What about profit, exchange or swap? What about, instruments? Why we swap this? Interest. So we will discuss, you know, means all different types in, short.
Okay.
I don't want to go in deep because I think which is not required for you as well, means
Yeah.
detail like technical terms and all, but basic understanding. Am I right?
Yeah. Yeah.
All right. So now if I talk about, let's say, interest rate swaps. See, finance market, we have two types of interest rates.
Okay.
One is fixed interest rate. Another one is
No.
floating. So floating, it means it fluctuate.
Fluctuate. Yeah.
When RBI announce, rates, then this interest rate fluctuate. And fixed, which is something throughout the investment period, your interest rate would be fixed for entire duration.
Mm.
So, for example, let's say there is one party or both parties A and B. They have loan of 1 lakh, which is a personal loan. This party is paying 12% interest rate, and this party
Mm.
is paying 10% interest rate.
Yeah.
See, floating interest rate, which is depends on the RBI, right? What if
Yeah.
RBI continuously increase the interest rates?
Mm.
Then eventually this B will have to pay more and more interest rates, correct?
Correct. Yeah.
And if I talk about fixed, so fixed interest rate basically which is a fixed. What if let's say RBI announce lower the interest rate? So it means people they don't need to pay higher, they just need to pay lower the interest rate.
Mm.
What if let's say RBI announce 8% interest rate?
Mm.
8%. Then in that case, basically A is paying more interest rate, right? Just
Yeah.
because the A has obligation of fixed interest,
Yeah. 12. Mm.
right?
Yeah.
So through swaps, you can exchange your fixed interest rate with anyone
Okay. Mm.
who is holding again the liability of 10 lakh, like loan,
Mm.
and ready to exchange the interest rate with you.
Okay.
Maybe let's say the B is interested, then what you can
Mm.
do, you can sign contract with B, and let's say B is
Mm.
interested in your fixed interest rate, then B can sign
Mm.
contract with you for a
Mm.
fixed interest rate. So what you
Mm.
can do, guys, both can now every year you can exchange the interest rate.
Okay.
How? Let's say your annual liability of interest is, as per this, let's say calculation, on 10 lakh, which is 1 lakh 20,000, right? Net
Yeah.
interest
Mm.
pay to bank. And in
Correct.
case of this guy, the net liability is
Oh,
1 lakh,
one
correct?
lakh. Mm.
So this B will pay 1 lakh to you,
Mm.
and you need to pay 1 lakh 20,000 to B. Why?
Mm.
Because you both have signed interest rate exchange derivative swap contract.
Mm.
Am I right?
Yeah.
So every year basically they exchange the difference amount. So what is the difference amount here?
That is 20.
20, right?
Yeah.
So instead of sending full amount, they just send the 20,000 need difference every year.
Mm.
Basically, the party A will send to B, which is higher, because higher the liability, that party will only pay it to the lower the
Okay.
party,
Mm-mm.
right? So this is how your interest rate swaps works.
Okay.
Now your question would be like, who is that stupid, who is
Yeah.
going to lower the interest rate and now
Correct.
sign the
Yeah.
contract and paying higher interest rates, and why it is so?
Mm.
It is just because of future expectations. See, if there are no expectations, then you cannot execute derivative contract.
Okay.
As simple as that. The expectations comes with research. Let's say same stock, the one party is thinking about this price will go down, the another
Mm.
party is thinking about the price will go up.
Best. Oh.
So it means it's a tussle between buyer and seller.
Mm.
So everyone has their own investment research, objectives, and accordingly they'll take the investment decisions.
Mm.
Right now the interest rate is lower, but what if interest rate goes like 13%?
Le- Correct. Mm.
Then that floating wala, which he'll come in profit, right? Eventually,
Yeah.
because still he need to pay 12%,
Yeah.
and then the fixed, this A will pay 13, 1 lakh 30,000. So it means 10,000 that the A will have to pay higher.
Correct. Yeah.
So this is how they actually means through derivatives they protect their the interest or portfolio, I would say, to ensure that they are not paying higher liabilities. And if I talk about now hedge funds, they sign into the swaps like this to generate more and more income opportunities.
Mm.
But private equities they don't sign.
Okay.
You get it?
Yeah. Yeah.
Now the CDS, which we have already discussed, CDS is it's like a car insurance. I don't want to discuss that again.
Okay.
It's just a car insurance, means you
Mm.
can just purchase the insurance of your investments. That's all.
Mm.
Same way you can pay the amount to the LIC of India, then LIC of India will take care of your, your investment risk. If something happens to your investments, then LIC of India will contribute to you. The product we call it as a CDS, credit
See.
default
Default
swap.
swap. Okay.
Now we have also discussed about currency swaps.
Mm.
So every day, trillions of dollars you do currency swap. Every day.
Mm.
For example, let's say you're from India, your currency is INR, right?
Mm.
Now you want to travel to US, but US currency is USD. So without currency swap, can you travel to US?
No.
Let's say you have 84,000 in your pocket. So
Mm.
that 84,000 you need to deposit, right?
Yeah.
To withdraw, deposit rupees and withdraw
USD.
USD. So it means we basically swap it, correct?
Mm.
So if you deposit, let's say 8,400 rupees, then bank will pay you 8, sorry, 10 USD somewhere, because current rate
Mm.
is 84 USD or $88, 88 rupees something, right, for $1.
Mm.
But
Mm.
I'm assuming base rate, which is 84. So we will get 10 USD in
Mm.
your USD bank account, right?
Yeah.
USD bank account, and then only you can spend that money. Currency swap market, it's one of the largest markets on this planet.
Okay.
Every day trillions of dollars in a transaction that take place, because every cross border transactions they'll have to do the swap, currency swap,
Mm.
because US dollar it won't work in here in India, right? Then
Mm.
Indian
Yeah.
rupees it won't work in US.
Mm.
So it means They just execute currency swap transaction.
Okay.
For example, let's take another example. Elon Musk want to start business in India and looking
Mm.
for a 10,000 crores.
Okay.
But the Elon Musk want 10,000 crores in India only, right?
Yeah,
Not in
correct.
US, correct?
Yes, correct. Yeah.
So how Elon Musk will execute the contracts then? So Elon Musk will deposit $1 billion with RBI,
Mm.
all right? Because
Yeah.
RBI is the central counterparty for currency swaps.
Mm.
Or for every country they have their central bodies. They'll take care of it.
Mm.
So Elon Musk will reach out to the governor of RBI, will sign a contract. Look, I want to deposit $1 billion. Can you please issue the 1 billion worth of rupees INR,
Mm.
which equivalent to the 10,000 crores? Can you give it me 10,000 crores in INR so that I can spend the 10,000 crores in India to build my business?
Yeah.
But at the end, if you see, it was a currency swap.
Yeah. Mm.
They just exchange the currencies, means dollar versus rupees. And
Please.
once the
Okay.
rupees has been credited to his account in Indian bank's account, then that Elon Musk can spend that money anywhere.
Mm.
So same way, see, from normal any students who want to study abroad, to any
Mm.
the businessmen who want to start business in any jurisdiction, you know this currency swaps, means without currency swaps they cannot exchange their currencies,
Mm.
right? But
Yeah.
currency swaps you can also do it for hedging as well. Hedging, it means uh, now the dollar is continuously depreciating, right?
Yeah.
So through this currency swaps, what you can do, if the dollar is going up every day, then you can purchase dollars and you can sell USD. Sorry, you can sell INR.
Mm.
What will happen in that case? Even if let's say INR goes to the 90 or 100 or per dollar, right? Still you would be in profit. Why? Because the dollar is getting more stronger. So buy dollar then
Mm.
and hold it. Am I right?
Yeah.
So if you feel that dollar is now is performing very well and it is very in a strong position, so go to the marketplace, purchase dollars by selling your currency.
Mm.
And once let's say currency recovered from X to Y amount, then maybe you can again buy back the dollars. I means you can sell the dollars and you can purchase your currency back. So that again
Yeah.
comes under your currency swaps only,
Stop. Okay. Okay. Mm.
right?
Yeah.
And another contract which is profit swap, right?
Yeah. Yeah.
So I'll just explain in just 5 minutes. Profit swaps. See, if let's say you have a
Mm.
portfolio with 1 crore value, and that portfolio includes stocks, bonds, stocks of 80 crore and bonds of 20 crore. There is one guy who is looking for such a portfolio,
Okay.
but ready to pay 10% on portfolio value, 1 crore. Ready to pay
Okay.
10 lakhs every year.
Mm.
But this guy need a portfolio like this. So, and there is a person again, like let's say A, who don't know how to deal with market certainties, and looking for someone who can give him a 10 lakhs per annum, which is a fixed, right? Which is a fixed. But in
Mm.
exchange of 10 lakhs, this guy is ready to share the 1 lakhs, 1 crore worth of rupees portfolio with B.
Okay.
Then B can do anything with that portfolio. But
Mm.
B cannot sell that stocks or bonds,
Okay. Okay. Mm.
right? Cannot sell because actually
Mm.
the original owner is A, right?
Yeah. Correct.
But they can sign a contract.
Mm.
What if, let's say, one, sorry, it's 80 lakhs, 80 lakhs. So what if, let's say, what if 1 crore become 1.5 crore?
Mm.
So this 5 crore,
Profit.
one of, sorry, 50 lakhs, it will receive to the B.
Okay.
But we will only pay 10 lakhs. Why? It
Mm.
was
Okay.
committed.
Okay.
The reason is, if you see the profit on portfolio which has been swapped or
Mm.
exchanged with the B.
Okay. Okay.
That's what we signed contract, right? Otherwise,
Yeah.
why someone will pay 10 lakhs fixed amount to
Mm.
me? If I know that, let's say, this particular asset has no value or which is not a good asset, why should I pay 10 lakhs then? Are you getting my point?
Correct. Correct.
So this is how you can see the profit swaps as well, or profit swaps also you can call it as a revenue swap.
Okay.
Revenue from the portfolio which party can exchange with party B. So this is what we can call it as a revenue swap, IRS. Now your question would be, look, this case was about profit. Let's say due to market uncertainties,
Mm.
uh, this 1 crore worth become 50 lakhs. Then what will happen in that case?
Mm.
There is a loss of 50 lakhs and 1 crore become, after the signing
Relax.
of the contract, 1 crore become, let's say, 50 now. Means value of the
Mm.
portfolio is just 50.
Mm.
Then in that case, the loss of B would be 50 lakhs plus 10 lakhs. So total
Mm.
60 lakhs. So this is what the risk is all about.
Mm. Mm.
Because anyways, contract was signed for this notional amount, right? 1 crore.
Correct. Yeah. 1 crore.
So B is responsible for 1 crore anyways. After completion of the contracts, A will ask 1 crore worth of his portfolio. As simple as that.
Okay.
So on
Okay.
and above the 1 crore, everything that A will share with B.
Mm. Mm. Okay.
Even if it is a single penny change, that A is responsible to share with B.
Mm.
You get it?
Yeah. Yeah.
So this was all about profit swaps. So if you ask me, the challenges or technical terms, like every quarter or every month, basically they reset these terms and conditions. So that part we'll call it as a swap reset.
Okay.
And the risk, see, swaps are more risky because there is no central party. You don't know each other. Who is buyer, who is seller. Means in terms of your background, I would say
Okay.
you might lose your money. Right, let's say after having loss, because you are not asking for any money in advance, right? You are not depositing any money in advance, correct?
Correct. Yeah.
So you might, what if, let's say, after the loss, let's say B has now loss of 60 lakhs, right? So 10
Yeah.
lakhs which is a fixed amount and 50 lakhs which is a loss in the portfolio which the B has signed for. What if, let's say, now B denied to repay that? What will you do? You can't do anything
Yeah.
because
Correct.
there is no any central party, correct? Maybe you
Yeah.
can say, look, I'll file case, but what will happen? B can
Mm.
simply deny it.
Correct.
I don't have money now, I'm bankrupt. So that's the sort of risk which you may see in this swaps contracts.
Okay.
So
Okay.
swaps are more risky contracts when you compare with others,
Mm.
right? So
Yeah.
we'll discuss tomorrow forward,
Sure.
future and options.
Sure. Okay. Yeah.
So if you have any questions, so please go ahead.